All right, guys, the Fed and Jerome Powell, the head of the Fed, have just had their meeting and made a major announcement. And it's already had a ripple effect on the markets and potentially the banks. Remember, we've already had multiple banks fail here within the last 2 weeks or so. And this could be bad. And it's also what they're saying here going forward here for America, Americans, and the state of our economy. Take a listen to what he just said here moments ago, and then we'll discuss it here. Here we go.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation.
So, despite the Fed knowing that we've had multiple banks fail here in the last few days, the second and the third largest banks to fail in the United States ever, just within the last few days, and they know that the majority of the reason here was because of rising interest rates and the banks being sensitive to this and them holding treasuries and mortgage-backed securities and those being worth less because interest rates went up. What did the Fed do? They raised interest rates again. And what does this do to the American people? It raises costs on Americans. What has been happening to Americans? When Americans are living paycheck to paycheck, 2/3 of all Americans, over 200 million people in the United States, SNAP benefits just got cut for tens of millions of Americans. Child tax credits have been cut for tens of millions of Americans. Everybody's out here struggling. The Fed raises interest rates here yet again. Now, it's 0.25% this time, but what does this signal? That even despite the second and third largest banks to fail in the United States ever in the history of our country, they're going to continue raising rates. They don't care. They're going to continue pushing on this, even though they've now raised interest rates 9 times in roughly a year, the fastest pace I think ever in the history of our country. They're going to keep pounding away at it. They're literally just gung-ho at it. They're not concerned about the little man, the little guy, the average everyday American, small and middle class Americans, the people that go to work, live and breathe and die, or they're not really even that concerned about big banks failing either. They say they are, but they just failed. Massive banks worth over $200 billion just failed, and they're gone. They're literally just gone. And more could come, even more in the next few days, because they just raised interest rates yet again. And the problem with this is even though it's a small interest rate hike, is that they've signaled that they're going to continue raising interest rates if inflation stays high, which, I mean, it's being very stubborn. We've seen interest rates come down a little, or inflation come down a little bit, right? But if inflation stays stubborn for a while, which have you seen food prices? Have you seen rent prices? A lot of these things are not. Does anybody think food prices are going to go down? This is the problem here, is that, and as I've mentioned here, when they raise interest rates, it does not, at least in a lot of people's opinions, it does not lower the cost of, or even affect the cost of, a lot of things. So when they raise interest rates here today, is it going to lower the cost of your eggs? Can you go to the grocery stores and say, listen, they raised interest rates today, so can you lower the cost of your eggs and your milk and your butter here at the grocery store? Because that's supposed to bring inflation down. So I would like those prices to be lower here today, because the Fed, they're raising interest rates, and that's supposed to bring inflation down. So can my groceries be cheaper here today? Go ask the manager of the grocery store that, and see what they say to you. Because I think they're going to literally either look at you completely dumbfounded, like they have no idea what you're talking about, maybe even call the police on you because they think you're literally crazy, or they're going to laugh at you. And this is what the Fed is doing. Meanwhile, every time they raise interest rates, it raises your credit card interest rates. And every time they raise interest rates, it raises mortgage rates for people who have variable mortgage rates when they come up for, renegotiation, or anybody that's looking to buy a home, either their first home, or they have to move because of a job, or they're going to move at some point in the future, or any of those situations, or anybody that's going to buy a new car, buy a used car, or their current car dies and they have to go get another car. Any of those situations, anybody that needs a personal loan, all these type of things, right? It's costing America more money. And get this, right? We have right now in Congress, the debt ceiling struggle. America is spending about $1 trillion a year in interest on our debts. Every time they raise interest rates, it makes America's debts cost more money. Yeah, figured that one out. And they've signaled that they're going to literally just probably keep raising rates until inflation gets down to 2%. We're nowhere near 2%. So do you see the problem here? And this is going to cost America, the government, more money for months and months and years as well. Because interest rates are literally like way higher than they, it depends on which, index and, what you're looking at. But like when we look at like mortgage rates, they were less than 3% a year ago. Now they're 7%-ish. Again, it depends on the state and, what type of mortgage you're looking at, right? But when you go from 3% to 7%, that's more than double. And they just raised them here yet again. Credit card interest rates averaging over 20% now. 20%. That's per year, annual percentage rate. So, yeah, this is literally just like a living nightmare for a lot of people and for our government itself. Remember, the Fed is actually independent of the government. Like President Biden can't actually tell the Fed what to do. Jerome Powell is actually a Republican. He was actually appointed initially by former President Donald Trump, and Biden actually decided to keep him on. Now, a lot of people are calling to fire the Fed, which, again, I'm not from either party, but Jerome Powell is actually the decision, he's just kind of the head of the decision-making team. There's actually a kind of a board of directors there. But the problem here is that this could create a massive domino effect for banks, more banks to fail. And don't get me wrong here, the Treasury and the government has not said that they will ensure all depositors and all deposits will be guaranteed. They're putting on a nice big smiley happy face for everybody, but that has not happened. And when these big banks fail for hundreds of billions of dollars, that's a big pill for governments and banks to swallow. And when it happens, a lot of times there's a ripple effect. So I'll keep you up to date here, but I'm literally awestruck that the Fed, seeing these banks fail, knows what's going on, and they're just going to continue pounding America and the government, literally making the government pay more money every day by raising interest rates. I mean, anything that's interest rate sensitive is already being affected, and they're just going to continue doing it. So let me know your thoughts here in the comments, and I will keep you up to date here. If you appreciate these videos, don't forget to hit the like button for us. Comment down below your thoughts. And if you haven't yet, make sure to subscribe down below. Click the bell icon so you don't miss out on new videos that come out here every day at 10 a.m., 3 p.m., and 8 p.m. Eastern Standard Time. It is interest rate sensitive because our subscriptions here are completely free. Yeah, here's some videos you can watch next. Here's a video about an urgent warning that was just sent out to Americans. Or Social Security benefits could be cut by 24%. That's right. So click on one of those videos next. Thanks for watching, and I will see you in the next video.